Hello traders, Gary Wagner here, approximately 11:38 in Honolulu, 5:38 in New York on Friday. Happy Aloha Friday, as we say on the islands. It is the 25th of February, 2022, and this is the Daily Report for Gold and Silver, our weekend review. Against the backdrop of this week's invasion by Russia into Ukraine, as well as a report released by the government today showing yet another tick, this time in the PCE, of inflationary pressures, we have seen gold prices decline now for the second day in a row. Today, gold was down by $36.20 and is currently fixed at $1,890.10. That is a net decline of 1.88%. Yesterday, gold exhibited a dramatic price swing of about $100 from the low to the high price. And in fact, it closed well off of the highs, losing $5 and closing at approximately $19.05. However, in the case of yesterday's decline, it was largely, if not fully, attributed to dollar strength. The opposite is true today. We had gold going down and the dollar going down. The dollar index is down by 0.61% and currently fixed at 96.53. In fact, all of the precious metals did decline today, with palladium futures resulting in the greatest percentage drawdown, giving up $128.60. That's a net decline of over 5%, with an ounce of palladium still the king of the hill at $2,372.50. Silver also declined by 1.5%, a loss of approximately 38 cents, with the most active contract of silver futures currently fixed at $24.31. To give you an idea of the incredible volatility and price swings we witnessed, especially yesterday and somewhat today, we need simply to look at a short-term chart. We're looking at a 45-minute candlestick chart of gold futures. We can see that as the invasion began and the first strikes came in, we saw a tremendous rise in gold, first to 1950. You can see it kind of leveled off here, and then a tremendous spike up to the high, which came in, I believe, at $1,978 and change. But what followed was incredible, because there was immense dollar strength that came in, and that pretty much took away any of the gains in silver. I believe that the dollar was up almost a full percentage point, and gold was down about 0.28%. So you have a huge differential, resulting in a low yesterday of $1,878. Gold did recover from the low of yesterday and actually traded back to a high of approximately $1,920, but began to falter, trading back below $1,900, going to today's low, which came in at $1,884.40, before recovering slightly at $1,890.10. We did send out a trade alert. We are in fact long going into the weekend. We will cover the specifics of the trade, stop placement, as well as our upside targets in just a little bit. We are looking at a daily chart of gold. Although it is currently printing at $1,887.60, the actual current price is $1,890.10, and that reflects the difference between New York's closing price and the continuation into Globex up until 6 o'clock New York time, when trading ceases for the week. As I said, today we sent out a trade alert recommending that our subscribers go long, buying April gold at the market. At that time, we had gold trading at approximately $1,893.10. We also recommended that you place your stop at $1,874. First of all, the rationalization for placing our stop where we did. I wanted it to cover recent lows and activities over the last few days. This represents the entire week of trading, Monday through Friday. And as you can see, the stop is placed below that, including this exaggerated low that came in yesterday. Our rationale for placing a trade and going long gold, even though we had a decline today and we came well off of the highs yesterday, closing up slightly, was that over the weekend, the military operation in Ukraine is still fully in play. That being said, we could see that escalate to a degree that we haven't seen before, effectively and especially if the Russian government attempts to overthrow or topple the current administration to put in members that are much more pro-Russian, because up until now, the Russian militaries that invaded into Ukraine have not landed in Kiev. If in fact that's where they're headed, as most analysts believe, that would be the point in which we saw the Ukrainian military step up and have a resistance which would escalate the invasion into a full-scale war. The second reason we entered from the long side is that with this invasion, we have oil continuing to move higher. We have food prices continuing to move higher. In fact, Ukraine supplies a lot of the grains that go to Europe, and Russia, of course, produces approximately 10% of the global production of oil annually. The invasion by Russia into Ukraine actually sparked oil prices moving up past $100 per barrel, only briefly before it settled yesterday at approximately $93 per barrel. However, as a whole, inflation continues to go up and geopolitical tensions continue to rise, and that is why I believe that there is a very decent probability that we will see gold continuing to move higher. Lastly, I want to address our exit strategy and where we think gold could go to at the conclusion of the current leg of this rally. The first and obvious point that I think is very relevant is yesterday's high. That came in at a price we haven't seen for a year at $1,975, $1,976. I believe that a move back to those highs, and more importantly, to move there on a closing basis, is absolutely possible. And traders, this last chart we're looking at is a daily chart with one of the models we have been looking at with an Elliott wave count, Fibonacci retracement, but more importantly in this case, a Fibonacci extension. First off, we're making the assumption that we had a major correction that occurred that unfolded as a compression triangle, with this being the conclusion of a wave 1. This is our corrective wave 2, which now begins a corrective wave 3. Within that wave 3, we will have a 5 count that will then further subdivide our count as 1, 2, 3, 4, and then a 5th wave higher. We're only going to concentrate on this subcount 3, and this is what we're saying. When we look at the range that this first rally created, 1788 to 1976, as a potential top and completion of a wave 1, and then we look at this correction, meaning after hitting this high the other day and moving down, this actually is a 61% retracement of this entire move up. That is a very acceptable retracement level, which would put us into a wave 3, and that wave 3 could easily go as high as 2077 and could go much higher than that. Of course, there would be a subcount within this, but for the time being, our interim term forecast is looking for gold to challenge the all-time record high. This has been Gary Wagner, wishing you as always good trading. We will talk to you on Monday for the next daily update and review. Bye-bye.